I mentioned a little earlier that the listed property space has actually outperformed when you look at the rest of the asset classes on the JSE. And it seems that it's one of the favorites right now. Last year, it was frowned upon because it seemed slightly too expensive. Things are changing. Tell us about the scenario that is playing out.
Well, that's an amazing question over there, is that last year the property sector really outperformed the rest of the other asset classes with 30%. And even after that 30%, it still showed value relative to the bond market. Why? Is because the bond yields have compressed all the way down to 8%. A few weeks ago, they were below 8%. Property is still giving you a forward yield of 8.6%. You're getting more bang for your buck, as well as the fact that that yield is growing year on year.
With regards to what we're seeing in the bond market, give us an indication of why property makes sense right now, with regards to the long end of the curve.
And it's good that you compare it to the long end of the curve because it is a long-term asset. But as you say, if the long bond is giving you 8%, 8.1%, property is giving you 8.6%, you're getting a carry on your yield, you're getting more bang for your buck. Not only are you getting more bang for your buck, but it's growing. Your bond yields are static. So if you're buying an 8.1% yield, you're getting an 8.1% yield to maturity. However, if you're buying property at, call it a nominal value of 8.6%, and this is probably one of the few times you hear it, but thank goodness we live in an inflationary environment because that 8.6% yield is going to grow year after year after year.
Kevin, are you convinced?
It's compelling arguments, just we are probably at the bottom end, at the low of the interest rate cycle. In other words, bond yields should increase from here if you're taking more than a 2-year view and so on. Traditionally, what time in the interest rate cycle do you prefer to invest in property? And is this the best time if you're expecting rates to increase from here?
If you want perfection, you always want to buy property when it's the cheapest, and that would be when bond yields spike. However, at the moment, there's still opportunity, especially in the medium to the long term in the property space. Why is that? Is that, yes, there might be short-term weakness. If the bonds do spike beyond, call it 9%, there will be definitely short-term weakness. But we've done on an exit yield of 11%. For example, if the bonds go to 11% on a 10-year basis, and again, in-house at Sesfikile Capital, we've done the numbers, you will still get 13% on an IRR basis. If you assume 4% growth, you can gear that up, natural gearing approximately 30% in these companies. You will get 6% growth, and you're on an exit yield of 11%, not 8.1% where we are now. You will still get 13%. And I'm sure, compare that to any asset class, compared to inflation, there's still something on the table for everyone.
That's a compelling argument. Are you convinced now, Kevin?
Yeah, that's good enough for me.
Okay, let's touch on some of the stocks and exposure. If you want exposure to the property market, Growthpoint, of course, has been one of the favorites. It is on the top 40 index right now. Is it a company that you would want to buy into right now, or do you think that it's had its run?
I'll tell you what, Growthpoint makes me proud of that it's in the property sector. It's as professional as any company on the market. Just because it's property, it shouldn't be set aside. It is a top 40 stock at the moment. The price is looking a little bit full. However, with that said, it's an amazing story is that since it entered the top 40, you got the marginal buyer. It's not only something that the property people invest in, you're getting the generalists buying into Growthpoint. Today, I saw a lot of foreigners buying into the stock. If I'm not mistaken, I think the foreign holding has almost doubled in the last 2 years.
What about these companies, South African-based companies that are starting to increase their geographical footprint and buying properties out of South Africa? Is that the right move to make at this stage?
Again, some of it is better than the others. A lot of the guys, for example, Growthpoint, want to touch on that. They bought into a company called Orchards in Australia. It's now called Growthpoint International, well, Growthpoint Australia. An exceptional buy. They've doubled the size of that. It's at the moment, I think it's still a little bit undervalued. You're getting it over 9% on a forward yield. They've got some good, solid exposure there. Redefine did the same with Redefine International. They ventured into the UK, into Cromwell as well as Cromwell in Australia, and they went into the UK as well. And if you look at the Resilient Group, they ventured into Eastern Europe. So I think guys are taking a very cognizant step offshore to diversify some of that risk.
And what better time to do it with local currency that was strong about a week ago?
Yeah.
What about,
you need diversification into the rest of Africa?
You know, there's a little bit into Namibia. If you look at SA Corporate and Vukile, they have pushed into SA Corporate through a company called Oryx, and Vukile has got some assets in Namibia as well. However, as much as you go, if you go further north than that, unfortunately, the opportunity set, I wouldn't say it's limited, but they don't have the people on the ground. They don't have the experience on the ground. I think you're going to see more of it, but you know, in baby steps.
You're talking about positive returns. One company that perhaps is not doing as well is the likes of Emira, saying that in 2012 they're going to post a negative positive return. Is this indicative of what could happen in the whole sector, or is it just particular to Emira?
You know, that's a very interesting question as well, is that Emira, unfortunately, they're very much exposed to B-grade office, which is no fault of management. That's really just the sector they're exposed to, which is one of the weakest sectors at the moment. And one thing that comes out of that is that their vacancies were quite high, and they've got a lot of renewals in the next 12 months. So approximately they've got to fill about 30% of their space. With that comes, in a weak market, I wouldn't say an element of desperation, but it's very difficult. You've got to incentivize the brokers to let your space. So, you know, they've got to push money at them. Tenant installations. As soon as you get new people into the space, you've got to give them some office fittings. And all of that costs. So if they renew the existing space that they potentially could have vacant, it's going to cost them, you know, potentially up to 6 months plus in rental. So the cash flow is going to come under pressure.
Yeah. What about the Capital Property Fund? We're seeing amazing earnings there.
That's a beauty.
10% or so.
They don't seem to realize what's happening in the rest of the market. They just chug along, you know, with very high single digit or low double digit within this market is a great set of numbers, and they've really, an old colleague of mine called it bomb-proof. They built a portfolio for rainy days, and they did this about 5 or so years ago. They bought portfolios, they cleaned it out, and they made sure that in times like this, they could still chug along. For us, showing great value, it's still, you know, valued in line with the normal sector, but showing at least double the growth. One of our top picks.
Looking at Giokos, also an interesting company because it's fully empowered. The only fully empowered listed company, property company.
You know, we like Giokos at the moment. It's showing value. The one thing I think is a little bit unfair to label it as just empowered. They're actually a superb team on the ground. They've got good assets. You know, they own the likes of Hemingway Mall being their flagship. Now, there's some question marks around that, but if you look at Madansani Mall in the Eastern Cape exposure and their government office, a great portfolio, great and very entrepreneurial management. I'd like people to start shedding off the empowerment story and saying they're just a good property company.
Kevin, do you have exposure to property?
We do, but we primarily focus on the equities, but it's always interesting to hear the experts talk about it so that you can see where it fits in. But we have clients who are looking for yield, and one of the ways to get it is through property. And
so you'll definitely be looking at this asset class.
Just what are your thoughts on resilient?
Again, and part of that same stable as Capital, they've got a lot of developments coming through. That tail is starting to slow down a little bit, but they're still showing growth coming through from those, accretional growth coming through from those developments. And again, we're speaking about sector exposure. Emira, unfortunately, B-grade office in the northern suburbs. However, if you look at Resilient, a lot of it is non-metropolitan retail, where the guys are shopping in abundance, high volume, maybe lower margin, but again, the thing is ticking over and over again. And I always say, when I used to look at the likes of a Menlyn or a Gateway or a Sandton shopping centre, you want to see that people are shopping, not just ice cream liquors. You want to see people, we did they called a trolley test. You see them pushing the trolleys. In the resilient companies, I do a little thing that's a little bit different. It's called the rustle test. You close your eyes and you hear those packets rustle. And there's a lot of rustling going on there.
Promise you I wasn't holding any packets over the weekend.
Just some of the negative drivers at the moment, and it increases in administered prices. With the continuation, how much longer can companies expect to increase the rentals, considering that their tenants are under pressure?
That's a great question. That is the biggest concern on the ground. The listed prices are showing value, but the biggest question mark we have on the ground is, as you say, you're getting less and less for more and more with regards to rates and taxes. I was in the KZN visiting about 6 shopping centres yesterday. On average, they're paying 20 Rand a square metre. I know centres in northern suburb Joburg that are paying more in rates and taxes and water and lights than they're paying in rental. Yeah. So again, it's got to come to a head, that, because unfortunately, a lot of that is, not unfortunately, but a lot of that is recouped by the landlords, but the tenants will come under significant strain and they will start to fall over.